Asian stock markets ended the week in the red. Japan's Nikkei share index was under pressure on the back of a stronger yen as investors piled into safe haven assets. This as investors look to see what happens next following an international trade court ruling deeming the Trump administration's reciprocal tariffs as illegal. And since then, administration officials have appealed the decision, saying that they will be undeterred and that whatever happens, they will pursue Trump's trade policy agenda. The Nikkei share average declined by 1.22%. The Hang Seng Index closed down by 1.2%, while the Shanghai Composite Index ended the session 0.47% in the red. US markets ended the session a bit higher on Thursday, supported by positive corporate earnings and optimism in the tech sector following robust results from Nvidia earlier in the week. However, those gains were impeded by the prevailing uncertainty around what the Trump administration would do next following a court ruling calling his current tariff policy illegal. The Dow Jones Industrial Average rose by 0.3%. The S&P 500 gained 0.4%, while the Nasdaq Composite Index closed up 0.4%. On the local front, we see that the all-share index is down 0.4% at 94,393 index points. The rand is trading at 17.89 against the US dollar, 20.28 vis-a-vis the euro, and 24.12 against the British pound. Gold is trading at $3,295 an ounce, platinum at $1,073 an ounce, and Brent crude oil is trading at $63.85 a barrel. All right, let's get into conversation now with Patrick Matidi. He's the head of equity and balance funds at Aluwani Capital. Thank you so much, Patrick, for joining us. So, of course, there's a lot going on right now. It's been a hectic week. I just want your reflections on the week, on the global markets, and also this up and downing with the whole situation of the Trump tariffs. Currently, they have now been reinstated while the White House is appealing against the decision by the International Trade Court in Manhattan that says that those tariffs were actually illegal. So there's a lot of uncertainty.
Absolutely. And even if the appeal had not come through, you need to remember that the current tariffs that have been agreed, they've been agreed with a 60 to 90-day window within which they're still to be negotiated with other countries and be settled. So we still have an additional, level of uncertainty over the next few weeks, leading up to the expiry of that initial, 60 to 90 days, from early April when the Liberation Day announcements were made. So uncertainty abound, and you can see that playing out in all markets. Bond markets, especially in the US, have been very, very volatile. And then also in the currencies where the dollar is very weak, supporting the yen, where we are seeing a lot of flows out of the US and back into Japan, where we are seeing the bond market actually starting to show a bit of a higher yield, which is attractive for Japanese investors. I think on the domestic side also, it's been a very, very busy week. Thankfully, we had a settlement on the budget, budget 3.0, where we did see, I guess, not much disappointment coming through in the form of, expenditure side. But I think what we have seen since that is a downgrade on the outlook for growth for South Africa, where, especially given the fuel levy, its impact on the consumer and the economy is likely to be a bit more pronounced. We are seeing downgrades on the revenue collections for SARS, again, just given the weakness in the economy. But I guess the positive was yesterday, where we did see, the MPC cutting rates for the first time this year, with hopefully more to come as the year unwinds. So net for local markets, fairly positive. If you look at the JSE, very close to all-time highs. If you look at the bond market, it came down quite nicely yesterday after that rate cut. And then the currency, fairly volatile, reflecting more what's happening with the dollar than it is with the local events.
So are we going to see the JSE, the Aussie, hitting maybe 97,000, 100,000 index points this year? And what would it take for us to get there?
I think what we're saying globally is money flowing out of the US and some of it back home to home markets, just given what's happening in the US. Over and above just the volatility, the US market has been very, very expensive of late. Yes, so you do have pockets of growth and good earnings, especially the tech sector. But if some of these tariffs actually get implemented and we see, the reversal of what we have been seeing the last couple of years coming through, it is almost a given that the US economy will take a bit of a hit initially, with these high tariffs. Simply put, the counterparty countries will also have to increase their tariffs in terms of, exports to the US. And that means that, your average US consumer will have to pay more for what they import. Maybe in the fullness of time, things will settle down, but in the immediate term, we do see risks to the U.S. economy, and some of us are even seeing, risk of a recession, over the next couple of months. So I think, with that backdrop, we are seeing money going back to home markets. I mentioned Japan earlier on. The same is happening with other emerging markets, and also South Africa to some extent. We are seeing a little bit of money coming back, which is showing in the strength of the currency, and then some of it finding its way into the JSE and also the bond market, where we have seen foreigners also becoming a little bit more active on our domestic markets.
Yeah. At the top, when I asked you the first question, you covered everything that I wanted to cover. Let's go back to the MPC discussion. There was a discussion at length about the whole issue of inflation targeting, and the Reserve Bank governor saying that the lower the inflation target, then the lower interest rates will be. Does that necessarily follow, given the fact that South Africa is a net importer of goods? So depending on what's happening externally, if prices are rising externally, we can't control that. And when we import goods, we'd have to take whatever prices are being imposed on us.
Yeah, I think in theory, I'm not 100% you are correct. Well, the MPC is correct in saying, lower inflation implies lower interest rates going forward. But as you point out, if you look at our inflation basket, right, a big part of that is energy, both at oil price and also at Eskom. And then you also have what we call administered prices. So these are prices from different regulators in the country that get put on. So things like rates and taxes and the likes. And historically, those have been a lot higher than the official inflation rate on the 3 to 6% band, largely because municipalities have needed cash, and therefore it becomes easier to just put up higher rates and taxes just to collect and make sure that the books are able to balance. But I think what the MPC is saying is that inflation expectations need to be anchored lower, so that even those administered prices going forward, they need to start behaving like normal inflation and come in, at the official rate. And if we are able to get that mindset shift, then yes, we can achieve lower inflation and lower interest rates now going forward. I think what's also happening now is if you look at the other big component of the basket, that being oil has been lower for a lot longer, and it seems like there is an oil supply glut, and it is likely that oil prices will remain fairly depressed, which is good from an importer point of view. On the other side of the imports is exports. Our gold and platinum and other commodities have been doing well, which also helps cushion the inflation impact in the form of exports.
All right, super. Well, more to ask you, but not enough time. But I think we have got some good quality comments from you today. Thank you so much, Patrick, for your insights there. That was Patrick Matidi. He's the head of equity and balance funds at Aluwani Capital.